Good day, I'm Chartered, your accounting tutor. In today's video and class, we are going to look at illustration of financial statement of a sole trader. We are going to solve a practical illustration on financial statement of a sole trader. These are areas where learners find it very difficult. When they see adjustment, they find it very difficult to handle it in such a way that the account will balance. Mind you, account must balance because of what we call accounting equation. The two sides of the account must be equal. Assets equals to capital plus liability. And this must come with adjustment in the real life situation or in the standard question. And that is why I am going to solve the practical question that involves this adjustment. Mind you, we have treated all the adjustment, I have explained it one after another. And today, we are going to solve it practically as we see how they are solved. We have already presented the question to you, and the question have all the adjustments, and we are going to look at the adjustment one after another as it is presented when you are given a practical question or when you first see it in a real life situation. And that is what we are doing today. If you look at the question, it is clear that if I give you such a question to solve under examination situation or in a practical situation, the first thing is you have to handle the adjustment. Don't go and start reading the whole question. Yes, you can read the whole question, but as you read the whole question, all your attention should be focused on how you are going to handle the adjustment. Because if you are able to handle the adjustment correctly, the question must balance. But if you don't understand the adjustment, you find it very difficult for the question to balance. And that is why the first step is to handle the adjustment on the workings. Make sure you work them very clear and you know what you are doing. And then by the time you apply them in the question proper as you are solving them, the question must balance. Let's look at the adjustment as they appear in the question that was given, which I asked you to look at it carefully as we are going to solve it. Let's start the adjustment. As you present the adjustment, you must first start with workings. Make it clear that you are working the adjustment and the heading will be workings. After workings, you take the adjustment one after the another as they appear in the question. So if you look at the first adjustment, it's talking about rent. Rent is outstanding. Rent is outstanding at the end of the year. Rent is outstanding means rent was owing at the end of the accounting period. So if you look at it, this is how to handle the question. Here you handle the adjustment. Here you first pick the actual amount paid. This actual amount paid is found in the question. If you go to the trial balance, you discover that the actual amount of rate that was paid during the year is 20,550. This is the amount. This amount, mind I'm repeating, is picked from the trial balance. You go to the question, you see it. Rate was paid 20,550 naira. They come into adjustment. The adjustment is saying that rate is outstanding at the end of the year, worth 3,110 naira. So what do? All accruals are added. This is accrual of the current year. And I told you from the previous adjustment I have taught that all accruals are added irrespective of any accrual. Can be rate, can be insurance, can be anything. Provided it's an accrual of the current year, you add it up. And that is why we are adding the adjustment of rate which was accrued of outstanding worth 3,110 naira. If you add this to the initial amount that is paid given the trial balance, you now get 23,660 as the amount that we charge in the profit or loss under operating expenses, and this adjustment have been well handled. So you get it from it very clear that any item, any expenses you pick, and if the expenses is either outstanding or in arrears or accrued or due but not paid, the only thing you do is to pick the adjustment, the figure in the additional information, and then add it up with the one given in the trial balance. As you can see in the question, by the time you add it up, the amount you get is the amount they're going to pick and use in the financial statement under profit or loss, under operating expenses. Mind you, this adjustment can also be done directly as you are solving the question. You can either do it outside or as you are solving the question, you have three naira sign. The first naira sign will take care of this while you transfer this to second naira sign. But the best way to present it to make the work look neat and more professional, this is the way that is done, because all the adjustments should be solved outside in a very clear way before you now transfer the result into the financial statement, which will be short and clear without any ambiguity and to be clear to understand. Let's quickly go to the second adjustment. On the second adjustment, insurance was prepaid. Insurance was paid in advance. Read, it is clear that insurance was prepaid and the amount is 613 naira. How do you handle prepayment? All prepayments of the current year are deducted. All prepayment of the current year are deducted. So, here, it is still the same thing. Look at this. The term is clear. Actual amount paid. Where do you get actual amount paid? We get actual amount paid in the question, which is given in the trial. But this amount that was paid during the accounting period, 24,015 naira was paid, but it was not the all amount that was expected to be paid. And that's why they are reminding you from the adjustment that there was prepaid insurance of 630 naira. How do you handle prepayment? All prepayments are deducted. Then you pick the amount prepaid and then deduct it from the actual amount that was paid in the year to get the actual amount that's supposed to be used in the current year based on matching concept. Mind you, all adjustments are based on matching concept, which says that the actual revenue of that year must be adjusted or must match that of expenditure of that year to get the real amount to be charged in the profit or loss. Mind you, adjustments are done based on matching concept or what we call the accrual concept. So here I'm telling you that all prepayment are deducted, prepayment on the current year, be it insurance, be it rent, be it any expense that is prepaid, pick the amount in additional information, deduct it from the actual amount paid in the trial balance. What we get is what you are going to charge under operating expenses in the profit or loss statement. Let's go to the third adjustment. The third adjustment is lighting expenses. Lighting expenses was also in arrears. Right? Lighting expenses was also in what? Arrears. That it was owing, due but not paid. It is the same explanation without a rate. So we don't need to waste time here because we are able to appreciate what happened in rates. You don't have any issue with lighting. It's the same arrangement. Then you go and then pick the actual amount of lighting that was paid in the trial balance during the year, that brought the trial balance during the year, which was 8,590. Then what do? You now add accruals as in the case of rates. So this is accrual of the current year. So you now add it to the actual amount of lighting that was paid, then you get the amount that's supposed to be paid during the current year. And this is the amount that we charge in the profit or loss. P or L means this is what we charge as operating expenses in the profit or loss account. The next adjustment, as you can see, is bad debts. Bad debts and expenses. Mind you, I told you that bad debt is different from allowances for expected bad debts. Bad debt is a direct operating expenses treated as such. In this case, we have initial bad debt, means this one, the bad debt was already there in the current year or can be even in the previous year. But this is the bad debt that was discovered during the current year posting. At the end of the day, as the business end, another bad debt still occur. Then you now add the two together. This is the bad debt given the trouble, means the initial bad debt found during the accounting period as the transaction were going on. At the year end, additional bad debt was also discovered, which is given in the additional information. So what do? Bad debt as a direct expenses, you don't need to deduct, all is to add them together to know the total of bad debts that we use as an operating expenses. So in this case, the initial bad debts given the trial balance will be added to the additional bad debt found at the end of the current year under adjustment. So if you add it together, you get 1,200, which we charge as operating expenses on the statement of profit or what? Loss. So bad debt is easy to treat. It's just to add the two together. If it is only the initial one, you still use it direct as an operating expenses. If it is only the additional one, which is found in the information, you still pick it and use direct as an operating expenses. But if there are two, as in this question, add them together and the figure will be used as operating expenses, short and clear. Let's go to the next adjustment you can found under the question given initially. It is allowances for expected credit losses. Allowances for expected credit what? Losses. This is what is initially called provision for bad and doubtful debt. You also call it provision for bad and doubtful debt, but this is a new name by International Financial Reporting Standard. Allowances for expected credit what? Losses. How do you work it out? Mind you, I gave a detailed way to handle allowances, which is already clear in all the adjustment. I treat one after another. So here is to work it out. If you are not clear, you can still visit my lesson. You understand how allowances are being handled. How do you do? First, I told you that we have two types of allowances. Initial allowances found in the trial balance and the one in the current year given under adjustment. So the first thing is for you to calculate the current adjustment or the current allowances given in the additional information. How do you work it out? You work the percentages given. Look at the question. Allowances was 2% of trade receivable. Trade receivable. So you now work 2% of trade receivable. Mind you, before you work, if there was bad debts in the additional information, that is the current bad debt, mind you must deduct the bad debts in the current year from the trade receivable, in as much as it is based on trade receivable. If you did not deduct the current bad debt after trade receivable before working the percentage, you will get it wrong. Quote me, you will get it wrong. So if there is current bad debt, I'm talking of bad debt in a time frame, I'm not talking of the initial bad debt of 200, no. I'm talking of bad debt in additional information, that is the current bad debt. So what do? If you have to calculate allowances for bad debts, which is in percentage form, and there's bad debt in additional information, you must deduct the bad debt before working the percentage on the balance. And that is why we pick the account receivable given in the trial balance, which is 201,600. They now pick the bad debt, which is the current bad debt given in additional information. You deduct it from the account receivable and get a balance of 200,600. And that is the balance that we're going to work 2% of it to get the current allowances. Mind you, you must follow the procedure of what I'm saying, otherwise you get it wrong. If there is bad debts in additional information, you must deduct from the account receivable before you calculate the percentage on the balance. But if there was no bad debt additional information, go straight and work the percentage on the balance. Even if the initial one is given, don't deduct. It is only the current one that you deduct from account receivable before you work the percentage on the balance, as in this case. So now we now say 2% of 200,600 give you 4,012 naira. Then the initial allowances, which is already given in the trial balance, which was the previous allowances created based on what the debtors are expected not to pay, then you deduct it from the current allowances. Then you get 3,212 naira. This is an increase. This is what is called an increase. Because the initial bad debts was 800 naira and the current one 4,012, which is higher than the initial one. Now we now say that there is an increase in allowances for expected credit losses. And if it's an increase, this will be treated as an expenses. It's an increase. So mind you, if it's an increase, you treat it as expenses under profit or loss. This was already well explained under adjustment as I was treating it one after another. If you are confused, go and visit my lecture on adjustment. Then study carefully how allowances are handled. I was able to explain it the way you understand. Here I'm only trying to solve a practical question. But mind you, any increase of allowances of the current year to the previous year, it is an expense. But if it was a decrease, you treat it as an income added under gross profit. Let's go to the next one. The next one is allowances for discount allowable. Allowances for discount allowable. Allowances for discount allowable are treated the same thing the allowances for expected credit losses are treated. These allowances are also based on the account receivable of in the year, in the accounting period. So here, if you look at the question, allowances for discount allowed were 1% of the account receivable. 1% of account receivable. But how do you work it out? Before you work allowances for expected allowances for discount allowed, first, you must work on the balance that remains from debtors after deducting bad debt, after deducting the current year allowances for expected losses. It is the balance that remains that you are going to use it to calculate the percentage of allowances for discount allowable. And that is why before you work the percentage of 1% of account receivable, you must first deduct bad debts, which is already deducted here. That's why you can see we pick account receivable balance from the debtors, which was already from the account which was where bad debt was already deducted. 200,600 was remaining, and that's why we start from that point. You pick it here, then deduct the current allowances, which is 4,012 naira. You deduct it from the balance that remained after taking away bad debt. Then you now have 196,588 naira. This is the balance that we're going to work the percentage, 1% of discount allowable on it to be able to get the amount that we charge as profit or loss. So here, if you work 1% of this amount, you realize 1,966 naira. This is what we charge as an operating expenses. But mind you, I say that the way allowances for discount, the way allowances for expected credit losses are treated, it is the same way you handle allowances for discount allowable. In this case, this allowance was only given in the additional information. So if it is given only in the additional information, you treat it as an operating expenses because there was no initial allowances. So if it is only the additional information as in this question, mind you, the result will be treated as an operating expenses. But if initial one is given, mind you, you handle it exactly as allowances for expected credit losses are treated. So this is how allowances for discount allowable are treated. Next, we look at depreciation.